So tonight we'll be looking at sub-subsidiary. Sub-subsidiary is a case whereby a subsidiary has another subsidiary. Maybe where company A acquire company B. However, company B also acquire company C. Then company C becomes a sub-subsidiary to company A. Company C becomes a sub-subsidiary to company A. Because by virtue of company A owning company B, they also own whatever company B owns. So, and because company B owns company C, then we now see company A as what we call an ultimate parent to both company B and C. Ultimate parent. So when company A is to prepare consolidated accounts, they will consolidate both the report results of B and C to their own result in determining the group. If you remember, when we started learning group accounts, one of those conditions we said might warrant a parent company not to prepare consolidated accounts is where the parent company itself is a subsidiary to another company, and the ultimate parent have been informed that they don't want to prepare financial statements and they are fine with it, that okay, they will prepare the consolidated account for all of the group. So where we have company A as ultimate parent owning company B, while company B owns company C, then company C is seen as a subsidiary. Now, for the purpose of consolidation, yeah, we have two types of subsidiary. You can have a vertical group and a D-shaped group. A vertical group is where A owns B and B owns C. A does not have any investment in C. But a D-shaped group is where A owns B, B owns C, but A also have a direct investment in C. Maybe A owns 10% in C, then they went ahead to buy 60% in B, whereas B owns 80% in C. Then because A now owns B, it automatically make C their subsidiary. However, because they also have a direct investment in C, then that makes it a D-shaped group. We'll still look at the D-shaped group separately. Now, when we have a vertical group, the first thing that might be new to us here is calculating what we call effective interest rate. So effective percentage of holding is to know what percentage does the parent company actually controls in the subsidiary. What percentage does the parent company actually controls in the subsidiary? So it is calculated by multiplying the percentage of holding the parent has in their subsidiary multiplied by the percentage of holding the subsidiary has in the sub-subsidiary. So just like I said, A owns 60% in B and B owns 80% in C. To calculate the effective percentage of holding or effective interest in C of A, it will be 60% multiplied by 80%, and that will give us 48%. That will give us 48%. So, but the fact that it's giving us 48%, maybe the fact that 48% is not a controlling percentage, no, it doesn't matter here. Because they own B and B has control in C, automatically the ultimate parent also owns the sub-subsidiary. You cannot say because the percentage of holding is not up to 50%, then they will not consolidate. No, they will still consolidate it. That is number one. Number two is that what? Number two is that the date of acquisition. To determine the date of acquisition, we'll look at when did they gain control. If the date of acquisition for the subsidiary is easier to determine, whenever they get their own percentage, their own controlling interest in the subsidiary, is what will be the date of acquisition. Now, if the subsidiary now acquires the sub-subsidiary after the ultimate parent has acquired their own interest in the subsidiary, then whatever date the subsidiary acquires their interest in the sub-subsidiary is what will be the date of acquisition of the sub-subsidiary. What do I mean? A acquires B on 1st January 2016. Then B acquires C on 1st May 2016. The date of acquisition of C to A is that 1st May 2016 because they were acquired after the acquisition of the subsidiary. The second case is where the ultimate parent acquired the subsidiary, and it is on that same day the subsidiary is acquiring the sub-subsidiary. No issue. The same date is what they will have as date of acquisition. That is, A acquires B on 1st January 2016, and B is also acquiring C on 1st January 2016. All of them will have date of acquisition to be what? 1st January 2016. The third scenario is where A has acquired B. A acquired B 1st January 2016, but B has already acquired C since, let's say, 1st January 2012. B has already acquired C since 1st January 2012, but A only acquired B 1st January 2016. It is still that same 1st January 2016 that will be taken to be the date of acquisition of B, because it is the control they acquire in B that makes them acquire C. It is that same 1st January that will be seen as the date of acquisition of C. That's that. So the next thing is purchase consideration. Purchase consideration paid by the subsidiary to acquire the sub-subsidiary. Whatever purchase consideration the subsidiary pays to acquire the sub-subsidiary, it will be apportioned between the parent, which is the ultimate parent now, A, and the NCI in the subsidiary, which is B now. That is, that amount will be apportioned between A and B. A and NCI in B. A being the parent, NCI in B being the other party that owns it, because whatever B is now doing, it is owned by two parties, which is parent and NCI. So the goodwill, the purchase consideration will also be split in their percentage of holding. Why that of the parents? Why that of the parents? Why that of the parents is added to the cost of investment in the subsidiary when they are calculating goodwill? The portion of the subsidiary, the portion of NCI is deducted from their value, is deducted from the NCI value. The portion of the NCI value is deducted from the NCI value at the date of consolidation. Is deducted from the NCI value at the date of consolidation. So the to calculate the goodwill, it is very easy. Just the cost of the, in the sub-subsidiary now, it is just the cost of the indirect investment. What is the indirect investment? It is the percentage the parent owes in the subsidiary multiplied by whatever purchase consideration the subsidiary paid to acquire the sub-subsidiary. Then we bring NCI. using the effective interest rate, like the example I gave before, if the effective interest rate is 48%, the NCI will be what? 52%. So we calculate 52% of the net assets. Then we now less the fair value and get our goodwill as we normally do it. And if there is what's it called? If there is any this thing, if there is any what's it called? Impairment, we less it. Then for NCI, we bring the value at the date of acquisition. We add their share of post-acquisition earnings. Then we now less the portion of NCI. The portion NCI we pay of the cost of acquiring the sub-subsidiary. We less it from it and we get NCI value at the date of consolidation. So let's just look at maybe one or two questions, then we'll call it a time. Let's look at one or two questions, then we'll call it a time. So can someone us to question one? Can someone quickly take us to question one? Can you guys hear me? Hello?
Yes, sir. I can hear you. Can you display it on your screen?
I can hear you, sir.
It's showing on my screen now. Can't you guys see my screen?
Okay, okay. Question one. The following is the summarized statement of financial position of husband PLC, wife PLC, and son PLC as at 30th September 20x9. So we have assets, equity and liability, non-current liabilities. All figures are assumed to be correct. So I cannot see the remaining part of the question.
There you go. Oh yeah, continue.
So I'm not seeing your screen.
I don't know the network you are using. No. Can others see
Relevant
my
news.
screen? Continue.
Precious, you are muted.
Someone else should just take up the question now.
Relevant note: Husband PLC purchased 55% of the equity shares of Wife PLC on 1st January 20x7 when the retained earnings of Wife PLC were $88 million. Wife PLC acquired 80% of the equity shares of Sun PLC on 30th June 20x8 when the retained earnings of Sun PLC stood at $70.5 million. It is the policy of the group to measure the non-controlling interest at acquisition using the proportionate of net assets basis. Husband supplies a component to Wife PLC and Sun PLC at cost plus markup of 25%. On 30th September 20x9, the inventories of Wife PLC included 3.8 million and the inventories of Sun PLC included 4 million in respect of this component. The trade receivables of Husband PLC showed an amount of $2 million receivable from Wife PLC, while the trade payables of Wife PLC showed an amount payable to Husband PLC of 1.5 million. The difference being as a result check sent by Wife PLC on 28 September, which was not yet received by Husband PLC until 2nd of October 2009. Required, prepare the consolidated statement of financial position for Husband Group as at 30 September 2009.
Okay, good. So without wasting our time, we have husband group, we have husband group. So the first thing we have to look for,
Sir, please, this the screen is too tiny. Maybe you can make it bolder. Maybe
there's
I
no
don't know
way,
if it's just.
there is no way I can make it bolder. You can bend your phone or something to make it bigger on your own end. I'm using my full screen here.
No, I think that is because even the other ones, the other classes, is always in the bolder side. So I don't know why it's just
I don't
on
know.
this section in my.
I'm using the normal screen I use every classes. I don't know. This is the normal screen I use every classes, so I don't know why it's looking like that on your own end. Is that the same way it is for everybody this night? Can others see it clearly?
Yes, you can just zoom to see very well, but it's okay, sha.
No go, I get class. I tell you now.
So the first thing we will have is husband group, husband purchasing wife. Please, that person should kindly mute the mic. Husband purchasing wife, 55%.
This is nice. So I come to something with see what's happen.
Then wife acquiring son, 80%. Date of acquisition for wife will be 1 January 20x7. Then date of acquisition for son will be what? We're told that son was acquired by wife on 30th June 20x8, which was after husband acquired wife. So the date of acquisition for son will be 30th June 20x8. 20x8. Then the date of consolidation is 30 September 20x9. 30 September 20x9. Okay, so that means our post acquisition period are actually more than 1 year, so we are good to go. We are good to go. Then um, we have note 2. We have effective interest rate, effective interest in Sun. What is their effective interest in Sun PLC? The effective interest will be what? 55% multiplied by 80%. And that will give us what? Please, let's bring out our calculator. That will give us 44%. And with that, NCI in Sun, NCI in Sun will be 56%. 56%. Then we can now move to note 3. What did they say happen? They said they measure NCI at proportionate here. Good for us. Husband supply a component to wife and son PLC at cost plus markup of 25%. Okay. On 30th September 20X9, the inventories of wife included 3.8 million and the inventories of son included 4 million in respect of this component. So that gives rise to what? Unrealized profits. We have husband to wife. What is the unrealized profit? That will be 25 over 125. Don't forget, markup to margin. Multiply by what? The inventory they had of it, 3.8 million. 3.8 million. And that will give us how much? That will give us 760,000. 760,000. And what do we do to it? We'll debit the retained earnings of who? Husband, which is the seller, and credit the consolidated inventory. Then we have unrealized profit, husband to son. Husband to son. Let's call that note 4. We have also what? 25 over 125 multiplied by 4 million. Multiply by 4 million. And that will give us what? 800,000, right? 800,000. And that will be what? We debit the retained earnings of husband and credit consolidated inventory. And credit consolidated inventory. Then we can move to note 5. Note 5 will be what? It said the trade receivables of husband PLC showed an amount of 2 million receivable from wife, while trade payables of wife showed an amount payable to husband as 1.5 million. The difference is as a result of check sent by wife PLC on 28th September, which was not received until this. So that is the check sent, we call it a cash in transit. And how do we treat cash in transit? For consolidation purpose, we assume the recipient has received it on the date of consolidation. So the 500,000, they said they sent. You know that's the difference. 2 million and 1.5 million. The difference is 500,000. 500,000 will be deemed to have been received. So we'll debit the cash and credit the receivables. So which is as a result of the 2 million they said minus the 1.5 million. Then the intra-group current account, which is the receivable and payables they are having, we said for the purpose of consolidation, we eliminate intra-group current account, and that will be what? 1.5 million. We'll debit that to account payables and credit it to receivables so as to cancel it from both sides. Do we understand? Do we understand?
Yes, sir.
Any question? Okay, with this now, we can now go ahead to net asset summary. Net asset summary. Net asset summary. We'll have what? Wife and son. We have DOA, DOC, then PAE. We have DOA, DOC, then PAE. So we have, what are this thing? We have ordinary share capital on their DOA. It is 150,000, 150,000, and it will be nil here. For son, it is 100,000, 100,000, and nil for post acquisition. Then share premium, it is 80,000, 80,000, because those ones will not have changed except otherwise stated. It doesn't change between date of acquisition to date of consolidation. Having done that, retained earnings. Retained earnings at the date of consolidation is 295. You know, the one we have in the statement of financial position is date of consolidation information. Date of consolidation information. While that of date of acquisition, we'll go to additional information to check for that. Like we have here, on the date of acquisition, the retained earnings was what? 88 million. So it will be 88,000. And then on the date of this on acquisition is 70.5 million. That will be 70,500. So what is our post acquisition? That should be 215,500. That should be 113,100.
The first one is 207,500.
Are you sure? 207, 295
It's 207.
minus 88,000. Okay. How did I mistake that? 207. Thank you for that correction. So, with that, in the absence of any other information, the unrealized profit, it was the parent that was selling. So there is no, we don't have any other thing to adjust in the net asset summary. So with that, we can calculate the what will be the um balance, the total of the values. So this will be 113,100. This will be 220,500. This will be 333. Abi? 333,600.
600.
This will be 207.
500.
525,500.
Huh? 565.
525,500.
5,
52.
318.
3 what?
318.
318,000.
3,000. So having calculated the net asset summary, we can now go ahead to calculate what? Goodwill. We can go ahead to calculate goodwill. And what will be goodwill? We will have wife and we will have son. So purchase consideration. So for purchase consideration, we will have what? Purchase consideration, we will have wife. They said they did not give us the amount they bought the equity of wife, but they told us here investment in wife is how much? 280,900. While investment in son, we cannot call it purchase consideration, rather we'll call it indirect investment. Indirect investment. And the indirect investment in son will now be their percentage of holding in the subsidiary, which is wife, multiplied by what wife paid to acquire son, 270,000. So with that, please, can this person mute, please? This your speaker is doing somehow. Okay, after doing the indirect investment, we can now say NCI. and NCI is as proportionate share. So for wife, it will be what? Wife NCI is 45%. What's wrong with this thing now? 45% of how much? 45% of 318,000. Sorry, I don't know what's wrong with my writing tab. It's doing somehow. It's just misbehaving. So we have that to be 45% of 318,000. And this one will be what? Don't forget, we calculated the effective at the NCI to be what? 56%. And that will be what? 56% of 220,500. And that will give us how much?
The first one is 143,100.
143,100.
100.
Why this should be 123,080.
123,480.
You guys did not give me the indirect investment.
One
That
That
should
one
forty
is
eight thousand five hundred.
148,500.
148,500. Then we can now say less fair value of net assets. Fair value of net assets in this case will be 318,000, while in this case it will be 220,500. And that will give us how much? So since they did not tell us there was any impairment of goodwill, whatever it gives us is the balance. Then we can now proceed to NCI. Still wife and son. Oh yeah, oh, value at acquisition.
For wife is
For wife,
106,000.
For wife, 106,000. Okay. For son,
51,480.
51,480. So the value at acquisition for NCI will be 143,100, then 123,480. Then we have what? Share of post acquisition earnings. Share of post acquisition earnings. So why we take what? 45% of 207,500. While Sun will take what? 56% of, that's their percentage of holding NCI of 113,100. And that will give us how much? For this,
93,375.
336. 93 what? 375.
375.
So in the absence of any other information, we can now say less purchase consideration in Sun. The purchase consideration in Sun will be what? They were holding 45% out of the purchase consideration of 270,000. So that will be what? 121,500. So if we take that out, what is the NCI value at the end of the date of consolidation? 186,
114.
816, 114,
114,975.
975. Okay. So we can now come to note 10. Group retained earnings. Group retained earnings. And the group retained earnings will have what? Husband's retained earnings. And the husband retained earnings will be what? It is 720, 800. So we can now bring every other thing. Share of post-acquisition earnings. They will share from wife what? 55% of 207,500. Then they will share from son 50, 44%, 44% of 113, 100. Then aside sharing of those two, we now have other adjustments to them like unrealized profit, 760 and 800. So we can see unrealized profit on inventory, 760 plus 800. That will give us 1,560 is a reduction. And aside that, I don't think we have any other thing. So what's the figure? What is the figure?
For wife, we have 114,
1,
125.
125.
For son, 5895.
5895. Are you sure? 113, 100 though.
We got
44%.
49,
Should be 4764.
764.
So aside that, I don't think we have any other information. So what will be the consolidated? What will be the consolidated retained earnings?
Sorry, 822, sorry, 882, 329.
882329. So if that is all we have there, then we can now go ahead to do we'll do consolidation, consolidated statements.
Size 883129.
That's fine.
So we can go ahead to consolidate husband's group. So for PPE, we will have what? 800, 800, 600 plus 420, 800 plus 300, 750. And that will give us how much? We don't have any.
1522
Yes.
150.
1522, 150. Then the investment cannot come in again. In place of the investment, what we will have is goodwill. And goodwill is how much? 106,000 plus 51,480.
I want to ask a question though.
Go on,
Under
go
the
on.
note 9, where we calculated the non-controlling interest, the third
Yes,
item there, where we got that 121,500, how did it,
yes.
like, what's, can you explain?
The purchase consideration of the sub subsidiary, the purchase consideration the subsidiary paid to the sub subsidiary. He said it will be allocated between parent and NCI. Parents will take their own portion, which is what we use to calculate the goodwill, while NCI portion will be deducted from the NCI value at the date of consolidation. So it's more like saying the NCI paid for it by taking out part of what they own in the business. Is it clear?
Yes, sir, thank you.
So that is that. So what else do we have? We have, as after goodwill, we have current assets. So the current assets will be 1,450,000 plus 369,100 plus 499,100. Then we had the cash in transit. We said they should debit cash. Abi, we said they should debit cash. So we'll add it to cash. No, sorry. Let's start with the unrealized profit. We have to credit inventory in both cases, 760 and 800. A credit to inventory will be a negative to this. So we'll say minus 760 minus 800. Then we said they should debit cash and credit receivable. That will be minus plus 500 for debit cash. Credit receivable will do minus 500. We'll do minus 500 minus 500. Then for the intergroup, 1.5 million is to credit receivable also. So we'll say minus 1,500. What do we have in total? What do we have in total?
2,315,140.
2,315,140.
140.
140, Abi.
Yes.
What do we have in total?
3,994,770.
994,770. Okay, for our equity and liability, ordinary shares. Don't forget, we don't consolidate equity. So we have ordinary shares 200,000. We have share premium 410,000. Then the group retained earnings, which we've calculated 883. 129. So what's the summation for our shareholders fund? Then we can now bring NCI. 114,975 plus 180. This one is,
Hello, sir.
I'm with you.
Current asset is 2317, not 2315. Current
So
asset 2317.
this your device. I don't know. It's really giving us the words are echoing somehow, but I will cross check and revert on that. Can someone else also confirm and give us feedback on that? You said you get 2317.
Yes, sir. 2317
No,
140.
it should be 2315, please. Check it again. It is 1,450,000 plus 369,100 plus 499,100 minus 760 minus 800 plus 500 minus 500 plus 1,005. Minus 1,005. That should be 231715 140. You can try it again, sir.
It's 2315 140. I've confirmed it again.
Okay. What's the shareholders fund and the NCI?
Yeah, that's one is 1,493,129.
493,129. NCI 301,791.
301,791.
Then, having done that, we can now go to non-current liability. And our non-current liability is 680,100 plus 209,100 plus 183,350. While our current liability is 520,600 plus 325,300 plus 285,900, then minus the intergroup of 1,005, because there we said we should debit payables, and that will give us how much?
1 million. The first one, 1,069,550.
1,069,550. The other one,
1,230,300.
1,230,300. 1,000,000 what?
1,230,300.
Are you sure it's 230 or
One
130?
million 130,300.
1,130,300. And that will give us what in total?
3 million.
3,994,770.
3,994,770. So that is that for that. And unfortunately, my system is getting down. So even if we start the next question, we may not be able to finish it before the thing will go off. So this is what we'll do. This is what we'll do. Any question on this? Any question on what we just did? Does anyone have any question on what we just did?
No